Good afternoon. This is Ken Law from Tortoise Capital with a review of the weekend trading report for February 20th, 2016. We have a market that is in bare normal conditions. On an annual basis, using weekly RSI 14, we're at neutral with a score of 44 out of 100. On a 10-day basis, using the 10-day NDX, we are overbought at 89 out of 100. Looking at the market mosaic, price with respect to the 200-day moving average is red bearish at minus 4.70%, so almost 3% into the bear. The slope of the 50-day moving average remains red bearish at minus 0.76%, but improving. The strength of trend is neutral at 24.9 with bulls still in charge. The risk index is a 30-period moving average of the VIX divided by the 10. The boundary between risk on and risk off is 1.0. The current reading is 0.987, so that puts us still in risk off conditions. When you compare that score to the last 5,000 trading days and find the average and standard deviation, we can compute the risk Z, which reads at minus 0.22. Here you see a 90-day histogram of that indicator. We've made a series of 3 lower lows, but have now made a higher low and are almost back to the zero line in terms of volatility, which could mark the beginning of a support level being put in place at the swing low and an opportunity to begin incrementing trades on the long side in the market relative strength leaders on a measured basis to ensure that we still respect that we're in bearish conditions. I would take this as a sign of a potential spring developing. Too soon to call, but the potential is there. In blended monthly rebalancing, you can see the holdings that we've had for this month with the next reevaluation due on or about 1 March. These are the leaders as of Friday's closing prices. In ETF 2, the theoretical exposure remains at 0% and the model itself remains at 70% exposed with stops in place. Here's a quick look at the relative strength leaders in the blended monthly rebalancing portfolios. Here's the ETF 13, only treasuries are on a buy signal. In ETF 32, it's gold, treasuries, and the defensive plays like utilities and consumer staples, and even emerging market bonds, with everything else being below its 4-month moving average. U.S. small caps in Latin America remain near the bottom in both stacks, along with Brazil and China in the ETF 32. In ETF Max, I've seen a lot of the volatility products got smashed this week, along with precious metals. And this is typical of the first bounce in a bear market when all of those products which exploit fear and suffering get smashed. In the S&P 500, Newmont Mining gave up some ground today. Tyson Foods looks to me to be very interesting. It's green across the board and was above average strength this week. Fastenal, Cisco, and Edwards Life Sciences also look to be interesting, and Public Storage, PSA, and Fleur Systems. They'll be on my short list to stalk. This is the market health check. The vertical blue lines are 10, 20, and 30 days worth of look back. Horizontal red lines are support levels that have held, and the purple lines are resistance lines that were once support levels but which now represent price targets on the ladder going up. You can see price here at about 192. The next target would be at the Z3 line and around 198. We don't get fully bullish until we get above the 211 swing high closing and going, so we're definitely in the tactical trade. You can see that we're below this red line, so we're underneath that 200-day moving average. The river is starting to narrow, Its slope is still down, but the Dragon has made 2 moves here in an effort to resume the long side trade. His slope is still up, and we've got a double bottom in play here at 181. And 4 days up, 1 day is sell off, and then some evidence of willingness to buy and hold over the weekend was made on Friday. So if we get above 194, I'm going to treat that as a very favorable sign, and that would lead me to believe in a possibility of 198, then a test at 202. Should we get failure here, then the obvious support levels are down here at 197, or correction, 187 at the edge of the river in the bottom of the Dragon. If that fails, then it's a retest of 181 down here at the double bottom. So we've got a evidence for a strong move being available in either direction, so that defines this as a critical state. The last time it was here, it failed. The time before that, it was here, it failed. And so the potential is there on both the long and the short side. Keep your risk measured and powder dry. In ETF2, everything is below its 4-month moving average in the major indexes, thus the 100% cash, 0% invested asset allocation model. Inside the sector spiders, it's only staples and utilities that are very strong, with some secondary strength in industrials, technology as well. In the world market model, all of the U.S. is below average except for the Dow and the S&P. Asia list Japan below average, China, Australia, Taiwan, South Korea, Thailand, and Philippines above average. Everything Europe below average except Belgium. Brazil really suffering. Everything else in the Western Hemisphere below average. Gold, silver, treasuries, corporate bonds, and real estate showing strength in the alternate asset classes. ETF 2, the ETF top 30s remain in the areas of gold, silver, precious metals, and then the short-term indexes. Malaysia has snuck into that top 10, as has the Euro currency ETF. In the Dow, still much more advanced strength rather than a weakness. We're now up to 3 in the red: Goldman, Boeing, and American Express on the downside. ExxonMobil has rejoined the top. It's green and white, so it may be early in its recovery. Chevron, United Health, and 3M in the mix. Weakness, white and green, in DuPont, Travelers, and Home Depot. And long-term strength remaining in Verizon, Procter & Gamble, and McDonald's. ETF liquidity for your review. In the daily, you can see that we've got some overreaction short side frames in place. I like to trade those by hand during the day. I like to see a price below the last day's low, and then negative momentum, and then I like to get short those. And we'll talk about that in the online swing workshop later tomorrow night. We've got some signals in the VIX on a number of systems. We have 5 good auto framer trade frames available. Plenty of dojis from Friday's price action in the Dow. Goldman Sachs offering a 5-to-1 reward to risk in the auto framer. Lots of good fraud quality numbers developing here. Friday's winners: Walmart, American Express, Nike, and Home Depot. Would not offend me to look for continued momentum plays on those. In the ETF 30, fewer dojis, more overreaction signals on the short side, and 4 good auto framers in play. Lots of good fraud quality numbers to choose from as well. Here's the stats on the auto framer. And on the regression line fractal framework, you can see on the top shelf in the green the symbols that are the most numbers of ATR below their own long-term fair value. So that would be the value plays at a deep discount. And so American Express offers 7.5 reward to risk using ATRs. Just get back to its RL 270. We'll look at that one tomorrow night. And these in the bottom shelf in the red are the ones that are the most numbers of ATR above their own RL270, and you can see how far advanced they are. So Procter & Gamble 5 and some change ATRs ahead of its fair value. And then these are our daily squeezes. These are 1 day swing and trade 1 day at a time, if you will. These are ones that have a narrow range yesterday, so 0.7 of the average range, but a large potential intraday move on the basis of the range stat divided by the mechanical risk is still greater than 2. So lots of goodies to choose from here. These are 1 day potential large range movers using a mechanical entry and mechanical risk, which could grow into a swing trade with markets money. Looking at the market mosaic, you can see the polynomial regression line has started to hook back up on the basis of the last 5 days. The slope of the 30-period regression line, which is that blue line, is almost back to the 0 line, having crossed its own 10-period last week. And you can see we've had a nice move in price this week. Still not out of the woods yet, but an improvement over where we were during those periods of the double bottom. Just flipping through the stats for you to review. You can see the strength in gold starting to slip, and some gains here in the U.S. indexes on the shorter term time holding. And looking at the slopes of the regression lines, you can see the 10 has made a higher high, is now deep into the advanced stages. This would it would not surprise me to see additional pullbacks here because the 10 has gotten fairly extended. The 30 is almost back to the 0 line. The 90 is starting to put in its double bottom, as you can see, and you can see price relative to the dragon here. Dragon's starting to get narrower as volatility is drying up a little bit, and so that's not unusual behavior to see in a market that is bottoming. You can't tell if it's bottoming until after the fact, but this is what it looks like on the front end. So I put us at a critical state as it tests this triple top right here. And that's everything that I want to cover from the daily report. Let's keep our risk measured and our powder dry. We remain in a critical state in a bear normal mode. It's still an election year. This move of the last week, while nice, was nothing exceptional, and the last 2 times it was here it failed, and so we're going to be prepared for strong moves in either direction. I'm maintaining my small number of active trades at a given time to reduce portfolio heat. I'm emphasizing the shorter term trades in order to generate markets money for anything that I want to hold overnight, and I'm looking at swing trades in the relative strength leaders, and I'm prepared to fund those with markets money from the day trading. So little to no change in my strategy over the last 6 weeks. This is Ken Long from Tortoise Capital. Keep your risk measured and your powder dry.